All right. Um, I'd like to continue our discussion for capital budgeting. All right. In the previous video lecture, we discussed the basics about capital budgeting, including the overview, the MPV and MPV rule, and the IRR and the IRR rule. And then we did one example about capital budgeting when there is tax. Okay, so our methodology is very simple. If there is tax, we're going to consider after-tax cash flows. All right, so in this video lecture, I'm going to discuss a few more extensions about capital budgeting. All right, so the first extension is extension number one. All right, multiple IRRs. Okay, so in some cases, the capital budgeting project you're looking at may actually have multiple IRRs, and if that's the case, then you may actually arrive at different conclusions if you look at one IRR versus the other IRR. Okay, so what should we do? Well, we know the ultimate standard is to go back to MPV. All right. So just to illustrate the cases of multiple IRR, let's look at example number 2 on your lecture notes. Okay, this actually is now corresponding to chapter 5 lecture notes. All right, so again, please have your lecture note on your side. All right, so consider the case of a company that operates sanitary landfills. All right, a landfill is basically a big hole in the ground where you can actually dump garbages, okay, until the hole is actually filled up. All right, so it's amazing how much garbage we actually produce every day. All right, so here are the cash flows, from this landfill project. Okay, first of all, you have to dig the hole. All right, so the initial cost is actually 800,000. All right, so these actually covers the cost of digging the hole, and just digging the hole is not enough. You have to put up fences around the hole so that people do not fall into it, and then you also need to provide appropriate access for dump trucks. Okay, so altogether that's going to cost you 800,000. All right, and once you have the hole ready, now you can actually charge people for dumping their garbages into the hole. All right, so the net annual cash flow from this is actually 450,000. All right, so these basically includes the fees the company can actually collect in return for giving this trash collection companies the right to dump their garbages in the landfill. All right, and these are actually net of any cost incurred by the landfill company. So, for example, employee salaries, benefits, compensation, and so on and so forth. All right. So after 5 years, well, the landfill is going to be full. So now you have to actually, close the, hole, and you have to actually, make sure you also, obey the, various regulations. All right. So this actually is costly. All right. So you have to actually incur another cost of, $1.5 million. All right. So if that's the case, how many IRRs do we have? All right. So let's just look at the setup. Okay. So the setup is, this is like the landfill project, and I'm just going to build a timeline here. And this is, today, and this is period 1, and we're talking about 5 years here. So let me just have 5 years for the moment, and then let's look at the cash flow per period. Okay. So today you have to invest in this project. You have to spend $800,000 to actually, dig the hole. All right, 800,000. And then, in the following 5 years, you have to, you can actually charge people, and this is actually 450,000. All right, so assuming this is the same amount for the following 5 years. Actually, I need a year 6 here because in year 6, this is when the landfill is going to be full. So now you have to actually, close the hole. All right, you basically have to cover the hole and so on and so forth. And this is actually incurring a cost of $1.5 million. All right, so this is the one of the cash flows from this project. Okay, if that's the case, how many IRRs do we have? All right, question. How many IRRs? Okay, so the answer, all right, in general, okay, this actually is a math problem. In general, the number of IRRs you have is equal to the number of times the cash flows change signs. Okay, so this actually is a math problem, as I said, but we're going to have to worry about the math problem. Instead, we can just use this as a rule of thumb. All right, so look at the cash flows here. It started out as negative, and then it flips to positive. Okay, it flips to positive. It stays positive for 5 years, and then it flips back to negative again. So this actually is known as the so-called flip-flop project. Okay, and the cash flows change sign twice. All right, so that means we're going to have two IRRs. Okay, so IRR1 and IRR2. So how do we actually go about these two IRRs? All right, so it looks like if you want to actually play with the IRR function, then you can actually look up all these cash flows. And oops, I think I just made a mistake. I meant to put a parentheses instead of a star sign. All right, so if you actually do this IRR function, if you look up all these cash flows, then the initial guess for the IRR actually matters in this case. So of course I know the answer already, so I'm cheating here. I'm just going to feed this IRR function with a 3% IRR. And indeed, there is one IRR that's actually close to 3%. And if you show the decimal, that's 2.68. Okay, now I can also play with the IRR function again, but this time I'm going to actually feed this IRR function with a different initial guess. So how about 20%? All right, let's just see whether this actually brings up. And indeed, this actually calculates the other IRR, which is 27.74%. Okay, so you see that some of you might be asking me, how do I know what are the initial guess I should actually provide when I actually use the IRR function? Okay, so if I want to close the loop, all right, to examine the number of IRRs, okay, we can actually plot the NPV, all right, against different discount rates, all right, and to examine how many times the NPV curve intersects with the x-axis. All right, so this is now a lot similar to the research project we did in the previous video lecture. So I'm going to actually look at discount rates here. All right, so I'm going to look at different discount rate, and I'm going to actually I'm actually going to just take an arbitrary discount rate, let's say 5%. All right, and if that's the case, can I calculate the NPV based on this discount rates? Well, some of you might be asking me, we're talking about IRR here. Why do you want to actually talk about discount rate? Well, remember, the IRR is the discount rate that makes the NPV equal to 0. So in this case, I can actually plot an NPV curve, and I can actually examine how many times the NPV curve intersects with the x-axis. Every time when the intersection happens, there is one IRR. All right, so that's the point. Okay, so I'm going to actually go ahead and calculate the NPV here. I'm using the 5%, and I'm going to look at the future cash flows. when you are using the NPV function, only pick up the future cash flows and then manually subtract the initial investment, right? So that is the NPV if the discount rate is actually 5%. Okay, so this is actually a very good project if the discount rate is 5%. All right, so it's actually $28,941.41. Okay, so now I want to actually look at the discount rates that can range from 0 to 2%. Okay, watch me closely how I'm actually producing this rate list of discount rates. So I'm going from 0 to 2 to 4, 6, and so on and so forth. Okay, so you may ask me, where do you want to stop? Well, to be honest, I don't know. So I'm just going to actually, look at, maybe something like, 32 or even 30, 36%. Okay, that's really high. All right. So now I can actually look at, hey, what is the NPV for each of the corresponding discount rates? Well, there are two ways for you to actually calculate the NPV. All right. One is actually you can go about, all right, so I'm going to calculate the NPV here by using a robust NPV function. Okay, so I'm going to look at the discount rate here. I'm going to look at the future cash flows here. And I want to be able to calculate the NPV for the other discount rate cases. So I'm going to lock down those cash flows. And I'm going to put back the negative initial investment. All right, so this is saying if the discount rate is 0, if there's no time value for money, then this project is a bad project because you actually lose $50,000. All right, and I can actually copy this down. I can actually get the NPV for the other the cases. Okay, so if it is, do I have a problem here? Well, I think, I just forgot to actually lock down the initial investment. All right, so let me just, redo this. And now I can actually copy this down here. And, these are the NPVs when the discount rate, varies, as indicated in column A. All right, so this is one way. Now, I can also use the data table to get this done. All right, so what I'm going to do here is very simple. I'm going to actually, copy this formula here. Remember, in the previous video lecture, we did a two-dimension data table. So we set up the annual rental income in the row and the market value of the condo in 10 years in a column. And then we have the, top left corner cell. And that is, copying the NPV calculation. So when you're doing the one-dimension data table, well, here I'm looking at what if the discount rate is 0? What if the discount rate is 2%? What if the discount rate is 4%? And so on and so forth. And I want Excel to actually populate the NPV for all these different cases. Okay. All right. So of course, you can actually do a one-dimension data table. And my hope is that we can actually replicate all these NPVs. All right, so I have been ready. So let me just highlight everything here. Everything includes, the cells you want to populate, the NPV, and the different discount rates, and the NPV calculation as well. So now I can actually go to data, what if, data table, and here let's think about how you can actually set up your data table. All right, first of all, we set up the discount rates in a column. So there's nothing set up in the row. So I'm just going to leave the row input cell blank. Now in the column input cell, the column is actually for different discount rates. Now when I calculate the NPV, the number in B160, what is the discount rate input I used? Well, that's the 5%. So that is the column input cell. All right, so now I can actually say, can I try this? Well, you see that Excel actually populates the NPV for the other, for all the different discount rate cases. And indeed, these numbers are actually identical. All right, so, but if you click on this one here, Excel says these numbers are actually coming from the data table. All right, so very nice review here. All right, so that's why I'm actually showing you you know, the data table approach as well as the robust MPV function approach. Okay, so now I'm going to plot the MPV, you know, into a chart. All right, so last time I also showed you how we can actually, you know, do a plot in Excel. It's actually very convenient. All right, so what I'm going to do here is very straightforward. I'm going to highlight, you know, the discount rates and the MPVs. And I'm going to actually go to Insert, and I want to do a chart. Okay, you know, I want Excel to recommend, and it looks like, you know, Excel is actually, you know, suggesting the first one here. So if you want, you can pick this one. Let me just pick this one here anyway. All right, so now this is actually a very nice looking chart. So I would say, let me just rename this chart so that it's actually very intuitive. MPV, for discount rate for different, okay, for different discount rates. All right. So now you see that, you know, the x-axis is the discount rates, the y-axis is the MPV. So now if you look at this chart here, what's the takeaway? All right, so the takeaway here is very straightforward. First of all, you know, the MPV curve intersects, all right, with the x-axis twice. All right, so you know, look at, there's one here, there's an intersection here, there's an intersection here. So this suggests, or this implies, that there are two IRRs. Okay, so, you know, of course, we have cheated already and we know the answer. All right, one is about, you know, 2.68%, one is about 27.74%. All right, so that is, you know, the two IRRs, and we can actually validate, you know, this observation, you know, by using the IRR function to calculate the exact IRR. And secondly, if you look at, you know, the discount rates, all right, so the universe of the discount rates, all right, is now split into essentially 3 intervals. Okay, and I can actually show you, you know, we can actually, you know, draw the conclusion as to what you should do, you know, when the discount rate actually falls into different intervals. All right, so interval, and then your conclusion. All right. So the first interval is anything is, you know, less than the first, IRR, which is 2.68%. Okay. In other words, anything to the left. So anything, you know, any discount rate to the left of the 2.68% MPV is negative. All right. So negative MPV because the MPV curve is actually below the x-axis. So don't take this project. All right. Discard it. So if the discount rate is actually between 2.68 and the second IRR, which is 27.74, I believe. All right, if that's the case, well, we're talking about, you know, this particular interval here for the discount rate. If the discount rate is actually in this interval, then positive MPV. Okay, so we should take this project. All right. On the other hand, if the discount rate is actually greater than 27.74, then again, you see that the MPV curve is below the x-axis, so negative MPV. You should discard the project. All right, so that's the takeaway from this, you know, a simple chart. All right, so by doing this chart, you know, even if you cannot figure out the two discount rate, you know, two IRRs, by feeding the different initial guess, you can actually, get a sense of where they are, and that should provide you with some clue as to, how you can actually, dig out the discount rates. All right, so that is extension number 1. All right, we know that in this case, you want to fall back on the MPV rule and look at whether the MPV is positive or negative depending on where the discount rate falls. All right, so that is extension number 1. All right, if you let me move on to next extension here, extension number 2, and that's actually about capital budgeting projects. I should say capital budgeting projects with different lifespan. All right. So we have actually two examples here. All right. So let me just go over example number 3 first. Okay. All right. So suppose your company is actually considering buying one of the two trucks. All right, to do stuff. All right. The company is actually trying to decide between two alternatives. All right. One is actually truck A. All right. One is actually truck B. Okay. And of course, I have the horizon here, which is the period. All right. So let's just look at this situation here. How many periods do we have? Well, we're talking about a 6-year life for truck A. So let me just have a 6-period timeline here. All right. 6-period timeline here. And all right, that's 5. One more. All right. So now let's look at the truck A here. If you actually buy truck A, it's actually very cheap, and it's actually going to cost 100,000. All right, and it's going to actually produce annual cash flows of 150,000. All right, and it's the same cash flow for the following 6 years. Okay. All right. Now, if you actually want to go with truck B, well, truck B is a more expensive truck. It's going to cost 250,000. All right, and it's only going to produce cash flows in the following 3 years. However, the cash flows are actually higher. They are actually 300,000 per year for the following 3 years. Okay. And let's just say the discount rate is 12%. Right? This again is provided, so you're gonna have to worry about it. All right. And the question here is which truck? Okay. All right. So you're actually trying to compare these two capital budgeting projects with different lifespan. Truck A is good for 6 years. Truck B is good for only 3 years. So what should we do? All right, so the analysis here, or the methodology here is very straightforward. All right, and I like to emphasize this. Okay, so for capital budgeting projects with different lifespan, all right, NPV in this case is not enough. All right, we should actually take one more step and calculate something called equivalent. All right, let me spell the full name here. Equivalent annuity cash flows. Okay, and this is noted by EAC. All right, so in other words, if you want to actually compare capital budgeting projects with different lifespan, then don't just stop at the NPV calculation, because the NPV actually has different lifespan. So really, you don't want to compare apples to oranges. All right, you want to actually compare the NPV by getting rid of the lifespan effects or getting rid of the lifespan difference. All right, so let me go ahead and calculate the NPV for this two anyway. All right, so for truck A, I'm going to use the NPV function here. The discount rate is 12%. I'm looking at future cash flows. I'm putting back initial investment, and that is my NPV for truck A. Okay, so this is actually 516,000 in the 7-Eleven, and I can also calculate the NPV for truck B here. So 12% discount rate, future cash flows, and put back initial investment. So that is the NPV for truck B. So if you just stop right here, you would actually arrive at the wrong conclusion, because truck A, yes, produces higher NPV, but it takes 6 years to produce this NPV. Whereas truck B produces lower NPV, but this NPV is actually taking only 3 years to materialize. Okay, so now we need to actually remember, I should say, these MPVs have their own lifespan. All right. In other words, it's like money has time value. Okay. So back to Linda Jones problem. You save. You withdraw. These cash flows occur at different points in time, so they have different timestamp. And here, these MPVs, they also have their own timestamp. That timestamp is actually corresponding to the lifespan. So really, if I want to actually compare them, I should actually find a way to get rid of that. All right. So how do I get rid of that? So let's think about this MPV for truck A for a second. It takes me 6 years to realize this MPV. All right. So it takes 6 years to realize the MPV for A. All right. And it takes only 3 years to realize the MPV for B. So I might want to actually change the perspective, and I want to actually, ask the following. All right. If I think of the MPV for A as an annuity, as the present value of an annuity, all right, what is the constant annual cash flow in this annuity? All right. In other words, realizing an MPV of 5, 16, 7, 11 over the course of 6 years, that is like realizing how much per year? Well, we know how to do that. All right. So I'm going to actually calculate the constant cash flow for this MPV based on this MPV for A. All right. The discount rate is 12%. And it's taking me 6 years to realize that. And the present value is actually this 5, 16, 7, 11, and the future value is 0. So yes, that's actually 125,677. All right. So in other words, this is telling me realizing the MPV of 5, 16, 7, 11 over the course of 6 years, that is equivalent as realizing 125,677 per year for a total of 6 years. All right. So if that's the case, I can actually look at, hey, if I want to think of this 470,000 as the MPV, as the present value of another annuity, what is the constant cash flow for that annuity? All right. Well, I can actually, look at this 12% here as well. And this is only for 3 years. The present value is this MPV here, and the future value is 0. So that's actually 195. So you see that in this case, these actually is a better deal because you actually receive, higher annual cash flows if you go with truck B. And these two numbers, we call them EAC, all right, equivalent annuity cash flows, all right? So based on the EAC, all right, now we can actually compare these two numbers because these are actually annual cash flows. So, it's actually corresponding to, the cash flow in a year, and that is very much comparable, all right? So based on the EAC, truck B is preferred. Okay, so that is, I want to actually emphasize this point here, so I'm going to put this in bold. All right, so when you actually consider capital budgeting projects with different lifespan, the easiest way is to calculate the MPV and further, all right, let me repeat, and further convert that into EAC. All right, so that's example number 3. Let me look at example number 4 here. All right, this is another example of the capital budgeting with different lifespan. All right, so let's say you are actually running a hotel. It's your family business. All right, your grandparents, your parents, and you are now running this hotel. All right, and you are considering replacing the light bulb in a hotel. In a hotel you own. All right, so right now you're actually using the 100 watt per hour incandescent bulb, right? And this is the old technology, the old bulb. This actually is costing you $1 for each bulb, and average lifetime is actually 1,000 hours. Okay. Well, we know this is just the average, right? Some light bulbs, they actually last much longer, whereas others, they actually, die very quickly. All right. And now, because of the newer technology, you're thinking of replacing them with something called compact fluorescent. All right. So this actually is another, kind of, light bulb, and is actually much, newer technology. And I actually have a picture, in the, in the solution. So this is, the one on the left is this is old-fashioned, light bulb. The one on the right is the newer, and I believe you actually have, even newer, light bulbs these days. Okay. All right. So, let's get back to the, on the numbers, right? So, the new bulbs, they were costing $5 a piece, and they will produce the same brightness, all right? And it's only going to burn 15 watts per hour. And, their lifetime is actually much longer. It's good for 10,000 hours, all right? So if that's the case, let's also throw in the parameters for, electricity cost, all right? 10 cents per kilowatt. And your average use is actually 250 hours per month. And, monthly interest rate is 0.643%. The question is, do you want to stick with the old one or do you want to use the new one? All right, so I'm going to actually look at the old bulb, and I'm going to actually look at the new bulb here as well. All right, I put them side by side. Okay, I'm going to look at the price. The old bulb is actually costing $1 a piece. The new bulb is actually much more expensive. That's $5. Excuse me, this is not new bulb, it's new bulb. All right, $5 a piece. Okay, and then we have the lifetime. All right, life, span. The older one is good for 1,000 hours. Okay, and I should say, this is actually in hours. All right, the new one is actually good for 10,000 hours. Okay, so immediately you realize that these are actually, bulbs with different lifespan. Okay, and the watts. All right, the efficiency. All right, so the old one is actually burning, what's the number here? 100 watts per hour. Okay, so this is actually watts per hour. Okay, that's the efficiency for the new, for the old bulb. Apparently, it's burning a lot of electricity. The newer one is actually burning only 15 watts per hour. So that's actually, more, a lot more, efficient. All right, and we also have some other parameters. Okay, so electricity price. This actually is per kilowatt. It's dollar per kilowatt. All right, a kilowatt is 1,000 watts. Okay, so that is actually 10 cents. All right, $0.1 per kilowatt. Okay, and let's look at the usage. The usage is actually how many hours you burn per month. Okay, and that's actually 250. All right, if you want to estimate, so how many hours do you have to light up your hotel in a month? Well, you do the algebra. A month has about 30 days. Every day you may have to light up the hotel for, I don't know, 8 hours. So 30 days times 8 hours per day, that's actually 240. So that's actually fairly close. Okay, and we also have the interest rate. That's actually monthly, and this is 0.643%. All right, so that's everything we need. And the question is, all right, replace or not? Okay. All right. So what's the analysis? All right. So apparently these are light bulbs with different lifespan. Okay, so what is our methodology? Well, we need to calculate the MPV, and further, I should actually emphasize, so let me yell here for a second, and further, the EAC, okay, the equivalent annuity cash flows. All right, so now I'm going to actually look at the old bulb here first. Okay, I'm going to calculate the MPV for the old bulb, and I'm going to convert that into EAC. All right. So let's look at how many what's the timeline here. Well, if you think about this, the old bulb is good for 1,000 hours, and you're actually using 250 hours per month. So the older one is good for 4 months. All right. So I just need to build a timeline with 4 months. Okay. Actually, it's so simple. Let me just type down the numbers. All right. And then I'm going to look at the cash flows per period. Okay. And let's just look at initially you have to pay for it, and that's $1. All right. The old one is actually very cheap. It's mature technology. And now let's look at what's the cash flow in the first month. So in the first month, well, you're actually lighting up your hotel, all right, and you're actually paying the electricity. So we would have to look at how much electricity you're actually using. Well, that depends on how many hours you're lighting up and what's the efficiency. All right, so let's just look at, first of all, you have to light up, 250 hours, all right, and each hour, if you're using the old bulb, you're actually burning 100 watts. Okay, so if I do 250 times the 100, that's the total number of watts. Okay, and remember, you're paying 10 cents per kilowatt. So I need to actually divide this by 1,000, all right, just to convert that into kilowatts. Okay, so this number, if I press enter, is going to be the total number of kilowatts I'm burning using the using the old bulb, and I'm paying 10 cents per $10. Excuse me, 10 cents per kilowatt. All right, so that is actually $2.5. And actually, I want to put a negative sign here just to emphasize this is the cost. This is the cost of lightening up your hotel. All right, and this number is the same for the other months. So yes, I can go ahead and copy this across. Okay, if that's the case, I can actually look at what's the MPV here. All right, so the MPV is equal to MPV function here. This is the interest rate. These are the future cash flows, and then put back initial investment. All right, so this MPV is actually $10.84. It's negative because it's the cost, right? It's the cost of having a lit up hotel. All right. So now I have to convert that into EAC. All right. So what is the equivalent annuity cash flow here? So I'm going to think of the $10.84 as the present value of some kind of annuity. And I'm going to actually look at what is the constant monthly cash flow that is actually equivalent to the present value of this annuity. All right, so again, I'm going to do a payment function here. The rate is this number here. It's for 4 months, for cash flows, and the present value is this one here, and the future value is 0. So that's going to be $2.75. So this is saying it's like you actually incur a cost of $2.75 per month, okay, if you go with the old bulb. All right, so now I can actually look at a new bulb here. All right, so I'm going to actually look at, first of all, how many months this is going to last. Well, the new bulb is actually good for 10,000 hours, and every month you're burning 250, so you're actually going to last for 40 hours. So now I have to build a little formula here, and let me just copy this across. Okay, I want to make sure I have 40 hours, 40 months is here. All right, so 40, where is my 40 here? Okay, 40, all right, that's 40 here. And I'm going to look at the cash flows per period if I go with the new bulb. All right, so today I have to buy it. It's $5. It's a cash outflow. And now I'm going to look at what's the cost of electricity per month. So again, I'm going to use 250 hours, 250 hours per month. Actually, I want to just put down 250. All right, and each hour is going to burn 15 watts. So that's going to be the total number of watts. and I'm going to divide this by 1000. So this way I get the total number of kilowatts, and this is now costing me 10 cents per kilowatt. Okay, so that's actually 38 cents per month because the bulbs are actually much more efficient. All right, and just to be consistent, let me put a negative sign here. All right, so I can now copy this across. Every month I'm paying a lot less electricity bill because I'm using newer bulbs. All right, so I'm going to calculate the NPV for the new bulb now. So this is equal to NPV. The discount rate is this number here, and the cash flows are actually from C220 colon. I'm using colon to pick up the numbers in between. And the last one is actually AP220. Okay, AP220, and then I put back initial investment. All right, so that is the NPV for the new bulb, and it's $18.19. Again, if you're just looking at the NPV right here, then you might be thinking, you know what, the new bulb is actually more expensive. Again, that fails to acknowledge the different lifespan for the different bulbs. All right, so now I'm going to look at EAC, and so I'm going to do the payment function here again. The rate is this 0.643, and this is actually for 40 months. Okay, it takes you a long way. All right, and the present value is this number here, and the future value is 0. So yes, the EAC is only 52 cents. So the conclusion here is, all right, go with the new bulb. Okay, it's much more cost effective. All right, your monthly cost is about 52 cents as compared to $2.75. Okay, all right, so that is the example for capital budgeting with different lifespan. All right, so the bottom line is you have to consider the EAC on top of the NPV. All right, so I'm going to discuss one more extension here, extension number 3, and this actually is about I'm skipping the tax problem in chapter 5 and moving on to example number 8, capital budgeting when there is inflation. Okay, all right, so let's just look at example number 8. All right, I'm skipping the other examples, so please review them on your own. It's very easy for you to actually follow. All right, so you are considering an investment in a new widget machine. All right, so the machine is going to cost $9,500 today, and you have the widget sales forecast for years 1 to 6. Okay, and I'll provide you with the numbers in a second. All right, and if that's the case, all right, the question is asking, if the widget is actually selling for $15 a piece, and the price is actually going to go up by 4% because of inflation, your nominal discount rate is 12. What's the NPV? All right, so let me just take down the numbers here. Let's just look at the setup. All right, this actually is a bit more complicated. All right, so we know the inflation rate here is 4%. Okay, that's actually the question, assumption. All right, and you have the widget price today. That's actually $14 a piece. All right, and you also have the nominal discount rate. All right, so I'll get back to that to this in a second. All right, nominal discount rate is 12%. Okay, and you have the this is actually looking at 6-year horizon. So let me just build a simple timeline here. This is today, and this is actually 1 year from today, and we have 6 years here. The machine is good for 6 years. Okay, and 6 years. All right, and now let's look at the sales forecast, or I should say widget sales. All right, so you're actually expecting to sell 100 units in the first year, 125 in the second year, and a 150, 160, 170, and 200. All right, so these are actually given. Okay, so don't ask me where the numbers come from. They're just assumed. All right, if that's the case, can you actually question? The real NPV, the nominal NPV, and the real IRR, and the nominal IRR. All right, so these are the questions now we have to, we have to address. Okay, so what's the analysis? The analysis here is very straightforward. All right, when there is inflation, okay, we will have two kinds of NPVs. Actually, we will have two kinds of, first of all, discount rates. So you have the nominal discount rate, nominal, right? Nominal discount rate. And in addition, you also have something called real discount rates. Okay, so the nominal discount rate is actually 12%. This is actually given. All right. So the inflation is actually, inflation rate is 4%. So what's the real discount rate? Some of you may recall from your Econ 101 or from your Finance 201, there's something called the Fisher equation, right? So let me just put down the Fisher equation here. I don't have time to review this. All right, Fisher equation. All right, so let me just, provide you with this Fisher equation here, okay? Let me call this R, big R, the nominal rate. Let me call this, small r, the real interest rate. We call this H, inflation rate. All right, then the Fisher equation says there is a relationship between these three quantities. So more specifically, the Fisher equation is saying 1 plus the big R is equal to 1 plus the small r times 1 plus the H. All right, so 1 plus H. All right, so that's the Fisher equation. So if you know any two rates here, you can actually solve for the the third rate. So I'm just going to look at this one here and say, how about I solve for this r, small r here. All right, so if I want to solve for the small r, I would do 1 plus big R. All right, 1 plus big R. I'm doing the manipulation here. 1 plus the big R divided by 1 plus H. All right, so I'm dividing both sides of the equation by 1 plus H, and this should be equal to 1 plus small r. So now I just need to subtract the 1 from both sides. All right, if I do that, I get my small r, which is the real rate. Okay, so I'm going to look at the real discount rate here, and that's going to be equal to parentheses 1 plus the big R, which is this number here, divided by parentheses 1 plus the inflation, which is this 4% here. All right, so that's the 1 plus big R over 1 plus H, and then minus 1. All right, so that number is the real rate, and it's actually 7.69%. Okay, so that's the real discount rates. All right, so we're going to have the real discount rate, and we're going to have the real or nominal discount rate. And correspondingly, we're going to have the nominal NPV based on or using the nominal discount rate. And we're going to have the real NPV based on or using the real, discount rates. Okay? So, of course, you can also have nominal IRR based on the nominal cash flows. Nominal cash flows, and you can also have the real IRR based on the real cash flows. All right, so that is very important. I like to actually make them in bold just to emphasize when there is inflation. Now you actually all of a sudden you have 6 different quantities for you to worry about. Okay, so I'm going to calculate case 1. you know, the nominal cash flow, nominal NPV, and the nominal IRR. All right. So I'm going to actually look at everything on the nominal basis. Okay. So let me just go ahead and copy and paste this thing here. All right. So I'm going to look at the cash flows per period. All right. So today I have to invest in this widget machine, and this machine is costing me $9,500. So it's negative $9,500. All right. And then I'm going to look at, how much I'm going to get, from the first period. Okay. Well, in the first period, I'm going to look at, well, before I do that, all right, so let me actually, let me actually take a step back. Let's actually look at the widget price. Okay. The price right now is actually 15. All right. The price right now is 15. And, what's the price in the first year? Well, the price in the first year is going to go up based on the previous price, which is $15 now. So the price in 1 year is going to be the $15 multiplied by 1 plus the inflation, which is 4%. Okay, so the price is going to become 15.60. And can I copy this down? Well, let me just copy down this, copy this down anyway. All right, so this calculates the widget price in the following years. And now I can actually look at nominal cash flows per period. Okay, so I look at, well, now today you're going to pay $9,500 to invest in this machine. And then in one period, you're going to sell 100 units, and each one you can sell it for 15.60. So you're getting $15.60 dollars for selling 100 units in the first year. And I can actually copy this down here. I can actually get the selling proceeds, from the other periods as well. So now I can actually look at, hey, what's my nominal NPV? Well, my nominal NPV is going to be equal to, well, here I'm going to use the nominal discount rate. So that's the 12%. All right. I'm looking at these nominal cash flows, and I'm putting back the initial investment, and that is going to be my nominal NPV. Okay. And that's $778.93. And I can also look at my nominal IRR. My nominal IRR is going to be the IRR based on the nominal cash flows. So these are the nominal cash flows, and that's actually 14%. Okay? All right, 14.47. So case 2. All right, so I'm going to look at the real real cash flows, the real NPV, and the real IRR. Okay, so how do we go about this? All right, I'm going to actually copy everything and paste it here. All right, and so everything is still on the nominal basis. So now I'm going to actually look at, hey, how do I actually get my real cash flows per period? Okay, as we're saying, you should actually look at, if you want to calculate nominal NPV, you look at the nominal cash flows. You look at the nominal discount rates. But if you want to get the real NPV, you look at the real cash flows. You look at the real discount rates. All right. So while this number is the same, it's in today's dollar term. So that's still 9,500 negative. So here, the 1560, that is actually nominal cash flows because it's actually based on the price of 15.60. Now the price is no longer 15. Instead, it's actually 15.60 because there's an inflation rate of 4%. So now if I want to actually get the real cash flow, watch me closely, I'm going to deflate. To some extent, it's like a discounting. So I'm going to deflate this at the inflation rate of 4% for one period. All right. So I'm going to actually deflate the nominal cash flows by 1 plus the inflation rate for the corresponding number of periods, or for the corresponding number of times the price is contaminated by inflation. All right. So I'll get 1,500. And I can actually copy this down here, and I get the nominal, real cash flows for all the other periods. So let's just double click this one here for a second. All right, so this is the cash flow in year 6, and I want to get the real cash flows. So what I do is I divide the nominal cash flows in year 6 by 1 plus the inflation rate raised to the power of 6, because the price has gone up 6 times. All right, so that is the real cash flow, and now I can actually get the real NPV. Oops, real NPV, and I want to actually use the NPV function here as well, but this time I have to look at my real discount rate, which is actually 7.69. Okay, I'm consistent. All right, I'm taking this real cash flows, and I'm putting back initial investment, and that number is still 778.93. So that's good. It doesn't matter whether you do the real cash flow calculation or nominal cash flow calculation. These two numbers are the same. All right. But now you can also look at what's the real IRR. Okay. So the real IRR is actually based on the real cash flows. So I'm going to actually look at all these real cash flows. It's actually 10%. All right, so it's 10.06. So alternatively, if you want to replicate the real IRR, well, you can actually use the Fisher equation as well. So you would do 1 plus the nominal IRR. All right, that's like the 1 plus the big R divided by 1 plus the inflation rate, and then minus 1. So if you do that, you should actually replicate 10.06. All right. So yes, that replicates the 10.06. Okay, this actually is from the Fisher equation. All right, Fisher equation, not Fisher. All right, so that is the methodology for dealing with capital budgeting when there is inflation. Okay, when there is inflation, we're just going to differentiate between real versus nominal terms. Real discount rate, versus real NPVs, real IRRs. All right, and this video is actually 1 hour, so I think I should really stop here. All right, if you have any questions, please let me know. All right, and this concludes our discussion for chapter 5.